Welcome back to the Wall Street Podcast.
Great to be here.
Today we're taking a deep dive into a research report from Morgan Stanley Asia Limited. It's dated August 21st, 2025, entitled Further Deterioration in Ads.
That's right. And this report, well, it really digs into the second quarter 2025 financials for Baidu and iQIYI.
Two major Chinese tech players.
Exactly. Morgan Stanley is looking closely at their core advertising businesses, their AI cloud efforts, and also autonomous driving.
And how all of that ultimately ties back to profitability, I assume.
Precisely. It's about understanding the current pressures and their big strategic bets for the future.
Okay, let's get into it then. Module 1.
Yeah.
The advertising picture and how AI fits in or perhaps doesn't fit in just yet. What's the main finding on ad performance?
Well, the outlook isn't great, frankly. Morgan Stanley is projecting Baidu's third quarter core ad revenue will actually decline.
Decline. By how much?
By 23% year over year. And remember, year over year just compares it to the same quarter last year.
23%. That's significant. What about iQIYI?
Similar story there, though maybe slightly less severe. Their online ad revenue dropped 13% year over year in the second quarter.
Okay, so broad weakness. But what about Baidu's AI integration in search? I heard that was progressing.
It is, technically. The report notes that AI-related search results now make up 64% of Baidu's traffic, which is quite high.
54%. So is that translating into ad dollars?
Not really, and that's the striking part. Those AI results only contributed about 16% to Baidu's Q2 ad revenue.
Wow. So is the AI integration actually failing to boost ad revenue for now? Maybe even hindering it?
You could say that. The report uses the term revenue lag. Basically, AI search is adopted, users like it, but monetizing it effectively, that's still a work in progress.
So the traditional ad revenue weakens before the AI side ramps up.
Exactly. Morgan Stanley expects significant AI monetization to, quote, gradually commence. It's a future prospect, not a current fix for the ad slump.
Makes sense. So if ads are down, where are they looking for growth? Let's talk diversification. AI cloud and robotaxi.
Right. These are the big strategic pivots. Baidu's AI cloud saw pretty strong growth. Revenue was up 27% year over year in Q2.
27%. What's driving that?
Mostly enterprise clients. It hit RMB 6.5 billion in the quarter.
Okay, that's substantial. And the robotaxi service, Apollo Go.
That's also expanding. It's now in 16 cities globally. They completed about 2.2 million rides just in the second quarter, often working with partners.
Sounds like progress on the tech front. But the key question is, do these initiatives offset that advertising weakness financially?
Well, partially. The AI cloud growth definitely helps cushion the blow on the revenue side.
Yeah.
But Morgan Stanley points out that the robotaxi service, Apollo Go, has limited financial contribution right now. It's very much a long-term play.
And these things cost money to build out, I imagine.
A lot of money. These investments are significant, and they're hitting the bottom line hard. Baidu's operating profit in Q2, it fell 66% year over year.
66%. Ouch. So the growth areas are currently, well, expensive.
Very expensive. They're essentially profit sinks in the near term, even if they hold future promise.
Which leads us neatly into the broader financial picture. Module 3. Margin pressure and valuations. What are the implications for profit and stock targets?
The margin pressure is clear. We mentioned Baidu's profit drop. For iQIYI, their Q2 non-GAAP operating profit fell a staggering 88% year over year.
88%. So profitability is really squeezed. How did Morgan Stanley react in their estimates?
They lowered Baidu's 2025 core earnings estimates by 12%, reflecting that pressure.
Yet both companies kept an equal weight rating.
Yes, which suggests Morgan Stanley sees their stocks performing roughly in line with the market average, not necessarily outperforming or underperforming dramatically.
Interesting. Did the price targets change?
For iQIYI, yes, slightly up. From US $1.70 to US $2.10. Baidu's target stayed put at US $100.
So what's the investment thesis behind that equal weight rating, given these, very mixed signals? Strong growth in cloud, but tough ad market and falling profits.
It really captures that balancing act. The equal weight reflects both the potential upsides and the current challenges.
Okay, break that down. Upsides first.
For iQIYI, it might be potential regulatory relief down the line. For Baidu, it's clearly that strong AI cloud growth we talked about that shows they can pivot successfully.
And the counterweights.
The cautious ad outlook is a major one. And critically, these huge investments in areas like robotaxis that are not profitable yet. They're necessary bets, perhaps, but costly right now.
So it's weighing the promise of future tech against the current financial drag.
Precisely. It's about future potential versus immediate profitability pressures.
Okay, let's bring this home. How do these big tech trends, AI search, cloud autonomous driving, translate to everyday experiences for the general public?
You'll likely see it in a couple of ways. First, online interactions will probably feel more personalized, more predictive, thanks to AI search getting smarter, getting answers, not just links.
Makes sense.
Second, while it might be gradual, autonomous taxis like Apollo Go will likely become more visible in cities. Self-driving cars moving from, concept to reality on the streets.
And for businesses listening.
The takeaway seems pretty clear from the report. Adapting to AI in marketing using cloud infrastructure, these are becoming essential, not optional, for staying competitive.
So this deep dive really highlights a critical moment, doesn't it? A shift away from challenged older revenue streams towards these promising but very capital-intensive future technologies.
It is. It's a complex navigation exercise between driving innovation and maintaining sustainable profits, a challenge many tech companies are facing globally, actually.
Indeed. And it leaves you wondering, doesn't it? As AI reshapes everything, are we entering a period where big short-term profit hits are simply the price of admission for long-term leadership? Something for all of us in the market to consider.